We're getting to the point where there is so little gold in the West now. And of course, the next thing is that when people wake up in the West, say, oh, we better have some gold, they run out and buy ETFs. When you see the price rise, are you going to try and sell some to push the price down a little bit? Are you Alasdair? You're going to hang on to your silver, so tight. It's not going to go anywhere near the markets. Now, these balances are basically what the Silver Institute tell us are the swing factor, which has stopped silver prices going to the moon by these people supplying the market to make up for the shortfall. There comes a point, Jesse, where this no longer happens.
Hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The other thing is that if you look at the exchange for physical numbers, they are actually very, very high, particularly in gold. Now, what that tells us is that it's an arbitrage between COMEX futures and London forwards. The exchange for physical basically is you go out of COMEX. What you do is you go out of COMEX and you go into a forward in order to take delivery. Now, you don't necessarily take delivery, and it could be the other way. So we have no idea as to exactly what the position is in the exchange for physical. But when you get high numbers, there is something going on in those markets. And just to remind you, when we had the run up late 2020, when gold first ran up to challenge new highs, 2070, something like that, there was a crisis in the exchange for physical. And, deliveries couldn't take place between markets because of COVID and all the rest of it. And I seem to recall that HSBC said that on the exchange for physical, they lost over $200 million just on that. So this is actually a very, very serious business. The point about COMEX is that it was never meant to be a delivery market. I mean, the concept of a future is that at expiry, you have the option, if you like, to either sell your future, in which case the position closes out because for every long there's a short. Okay, so it closes out. Because it's a very highly leveraged market, the players in futures almost never take delivery. So why is everyone taking delivery now? Well, not everyone, but I mean, you can see that there are huge, huge quantities standing for delivery. And I think a lot of it is there is such demand for gold, particularly from Asia. We can talk about that a little bit, what's driving that. But there is such heavy demand for gold that they're even going in to try and sort of get the loose holders out of futures. So it's a bid only market in effect for physical. And the only way you can get physical, go along to a refiner and say, when can you let us have some gold? They say back of the queue. If you go to, start dealing in the forward market in London, then you might be able to get some. But the amount of liquidity in the vaulting system, in the LBMA's vaulting system, I guess is extremely low. I mean, it shows that they've got, however many thousand tons, but, in practice, very little of that is really available, if you like, to satisfy market deliveries. And we've got the same situation in COMEX. Again, you've got quantities there which are basically not really available for delivery. I mean, some of them may be registered for delivery, some of them may be eligible for delivery, all that sort of stuff. But, the reality is that the liquidity in these markets, in Western markets, is drying up because of demand from Asia. And it's running into that brick wall. And I think this is why you've got these enormous quantities. I mean, 69 tons of gold is not a trifling amount. I mean, this is very, very serious stuff. This is more than most countries' gold reserves, since stood for delivery on the December contract, on the expiry of the December contract. And also, it seems in its dying days, you see people going out and buying the December contracts so they can take delivery. I mean, this is, honestly, Jesse, this is an extraordinary situation. And I think it does tell us that there are strains in the market. Now, we can't know precisely what those strains are, but this is the sort of thing I would expect to see ahead of a fairly significant move up in gold. We come back to the situation over debt, over the stability of credit in terms of its value. Now, clearly, there are central banks around the world who look at the relationship between gold and currency and basically want to get rid of their currency reserves and replace it with gold. What are they doing? Are they buying gold? No, actually, what they're doing is they're getting out of currency. They're getting out of credit. This is the key point. And this is also very much what the People's Bank of China has been doing. And it's being emulated by Chinese nationals, Chinese citizens, who not only take delivery of gold and, bars out of the Shanghai Gold Exchange system, they also run gold accounts at their banks. People's Bank of China, having reduced interest rates a little bit recently, alternative attraction, which is bank deposits. The Chinese housewife will take out a 3-year deposit in order to maximize the interest return. That's all coming down. So, of course, on a relative basis, it makes gold a lot more attractive. And bear in mind also that any Chinese national trying to hedge out of his currency can only do it in gold, because he can't go and buy dollars, buy euros, buy Canadian dollars, whatever. Can't do that. So, gold is the only thing they can do. And, of course, Russians now can go and buy gold. I mean, they can run a gold account at their banks. This is a world which is moving towards gold while we've been moving away from it. I mean, we're asleep, if you like, while this is going on. That, I believe, is what's going on. I mean, basically, we're getting to the point where there is so little gold in the West now. And of course, the next thing is that when people wake up in the West, say, "Oh, we better have some gold," they run out and buy ETFs. What's that going to do to prices? I mean, I think it's a one-way ticket. 1,324 tons have disappeared on standing for delivery. Now, I don't think it's actually necessarily gone out of the vaults yet, but I would suspect that this is all part and parcel of the shortage of silver around. If you're a manufacturer of photovoltaic cells or whatever, and you have been prescient enough to accumulate a stock of silver, which, you must have, okay. Assuming you've been prescient enough to do that, then when you see the price rise, are you going to try and sell some to push the price down a little bit? Are you hellers like you're going to hang on to your silver, so tight, it's not going to go anywhere near the markets? Now, these balances are basically what the Silver Institute tell us are the swing factor, which has stopped silver prices going to the moon by these people supplying the market to make up for the shortfall. There comes a point, Jesse, where this no longer happens. There comes a point where suddenly you find that, say, the supplies are not made available. And not only are the supplies not made available, but you find that those pesky people in the markets go and subscribe for physical ETFs. And we need this like a hole in the head because there isn't any silver. So, and they will be playing games. I mean, this is one reason, I'm not actually all that keen on ETFs because you don't have ownership of it. I mean, it's far better that, if you want silver, have the coins, have the bars in your own possession. If you have it in an ETF, you rather wish you'd actually gone for the real stuff. But the point is that there are huge shortages developing in silver.
Peter Schiff, a prominent economist and strategist, has raised concerns over the Federal Reserve's recent decision to lower interest rates. He contends that the Fed's actions are not addressing the root causes of inflation, but are rather a temporary fix designed to avert a financial crisis. Schiff argues that the rate cuts, marking the third reduction this year, primarily provide short-term relief to struggling banks and the labor market, rather than controlling inflation. He points out that these policies do not tackle the deeper, more systemic economic issues, and may worsen the long-term economic outlook. Furthermore, Schiff highlights the increasing demand for gold as a clear sign that investors are losing confidence in the effectiveness of the Federal Reserve's policies. With inflation continuing to rise, Schiff believes that gold is increasingly viewed as a safe haven, offering protection against both inflation and a weakening dollar. He stresses that gold serves as a reliable store of value in uncertain economic times, particularly when central banks, such as the Fed, cannot manage inflation effectively. Schiff predicts that as the Fed's monetary policies persist, demand for gold will only intensify, with investors seeking stability and wealth preservation amidst growing economic volatility.
The markets had already adjusted that down to maybe 2 to 3. So one of them they kind of took off the table. So people were expecting a hawkish cut today, in that the Fed was going to cut rates, but simultaneously indicate that it wasn't going to cut as much as it had thought before. But I guess the markets hadn't fully priced in or considered what that means, because this whole stock market rally has been predicated really on lower rates, and the idea that this new easing cycle is going to propel the market higher, just like prior easing cycles. And I've known that there was going to be a lot of bumps on this road, because I knew that the Fed was not making the progress on inflation that it had believed, or that it was claimed that it was having. And I think this was reality setting in when Powell talked about how inflation had picked up, how inflation was higher than the Fed had hoped or had anticipated, that it's taking longer to get inflation down to 2%. In fact, he said in the Q&A that he thinks it may take 1 or maybe 2 more years before inflation goes down to 2%. Now, I don't think it's going down to 2% at all in 2 years. So it's going to be a long wait. But if the Fed is going to have to wait 2 years to get inflation back down to 2%, well, it's going to have to be higher for longer than the markets expected. In fact, Powell even indicated that the neutral rate, the rate that the Federal Reserve believes is neutral for the economy, not stimulative, but not restrictive. They notched that up from maybe 2.8, 2.9% to 3%. And so that also means that there's fewer cuts necessary, maybe one less cut, to get down to where the Fed considers policy to be neutral. Now, the Fed did say that they still think they're well into restrictive territory. They lowered interest rates now down to 4.25, 4.5. So we're now a full 100 basis points lower than the peak. Although, despite this 100 basis point rate cut, the yield on the 10-year Treasury, which closed above 4.5 today, is now better than 80 basis points higher than it was when the Fed started to cut. So the Fed went down 100, but the market went up 80 on the 10-year, and even a little bit more on the 30-year. This hasn't happened in recent times, where the Fed has been cutting and the market has been moving in the other direction. And this shows that the markets are not believing the Fed to a degree. They're concerned about the growing deficits. In fact, they have this continuing resolution that is working its way through Congress now to keep the lights on, and that includes $110 billion of new spending, in addition to all the other spending, an extra $110 billion. Also, they threw in a raise. I guess that Congress is upset they haven't gotten a raise in the last 10 years. So they slipped a pay hike for themselves into this continuing resolution. But that alone adds another $110 billion to the debt over the next year, in addition to everything else that's adding. They're talking about the DOGE, commission to cut spending. They're already increasing it beyond where it already was. And in fact, the House of Representatives passed this Social Security Fairness Act. Who's going to be against Social Security fairness? But what it does is it increases benefits to civil service workers who are getting less benefits. Now this is going to change that, so they get full benefits. That costs an extra $20 billion a year. Just throw that onto the pile. And of course, if they estimate 20 billion a year, it's probably going to cost a lot more than that. But these guys are still adding on new government spending as deficits are exploding out of control. So the bond market is concerned about this. Now, I think it would be a lot worse for the bond market if the dollar was falling, but it's not. The dollar surged today to a new 2-year high, dollar index above 108. The euro, I think, is it down to 103? Let me check where it is. The euro is trading at just under 104. So 103 and 3/4. It closed, it's up a little bit in the evening. It was at 103 and a half. But dollar index above 108. So the dollar is soaring. It's the only thing that was up today was the dollar. Everything else, the stock market, the bond market, the Russell 2000 was down better than 4% on the day. And, the Russell 2000 is now down 1% since Trump was elected. A couple of weeks ago, it was up 9%. So we've had a 10% decline, now a full-blown correction in the Russell 2000. The QQQ was down, that's the NASDAQ 100, was down 3.6 today after hitting a record yesterday. In fact, several NASDAQ stocks had some pretty big reversals today where they hit new highs and then they got clobbered later in the day after the rate hike. Everything was down except the dollar. Gold was down about $60 an ounce today. It's up about $10. Now it's up $30. I don't know. So now it's back above 2,600. It's just regained. I don't know what just happened. I looked at the price of gold 10 minutes ago and it was up $10. Now it's up $30. So it's regained half of the $60 loss already. So we're back above 2,600 at 2,612, but we were down below 2,600 when trading closed. But what's amazing? The gold stocks, again, got absolutely hammered today.